This is because the country who controls the reserve currency status has both a massive advantage in world trade and global events, as well as a responsibility, even if that obligation is typically unspoken. So the country that issues the global reserve currency is a de facto leader, which brings a ton of privilege, but also fastens a target on the back of that nation. The US dollar, to make sure that we're being very clear from the beginning, the US dollar has been the most used global reserve currency in history and also has been so for the last century. Here we go. The future of the US dollar. Here's some interesting things in the news that you're not seeing right now. This one, pretty high headlines, but pretty top of the headlines. But inflation ticking up to 2.7%. If this is your first webinar, then you might not have heard this. If you're returning for multiple, then you've definitely heard this. But we have covered inflation extensively. This webinar on the US dollar will also cover inflation and a lot of impacts and causes for different layers of inflation. But inflation ticking up, okay? We've heard a lot of news correspondents and a lot of news pundits talk about inflation ticking down and it's been resolved. We're seeing a pretty big tick up, 2.7, approaching 3%. Another one, this one you probably haven't heard in the news, is that affordability in the housing market nationally is going down. Still, it's worsening. It's still tougher to buy a home. With everything going on, with all the talks and concerns, why is that the case? One, we see inflation, which we just covered, still on the way up. That pushes up home values. We see rates looking higher for longer. So we're not seeing the same downward pressures on rates that we heard that rates are going to get cut and those are going to go back down. I mean, even Trump talking about a 3% rate cut, which I don't see anytime soon, but very interesting to see that being the case. So why is that? Why are we seeing home prices with such a worse affordability score, with home prices going up, with less people being able to afford a home? Comes back to baby boomers. The largest generation we've ever had, and then also the most wealthy generation we've ever had. We've talked in the past how baby boomers have a locked-in effect on homes. Many of them got homes in the 3-4% range, and now today are dealing with the decision, do they want to move and get a much higher rate for a new home? Well, now what we're seeing is that's actually shifting, and baby boomers are choosing to move in higher rates than we've seen in the past because they have so much equity built up in their homes. In the last 5 years, we've seen home values across the nation go up on average 47%. We've also seen rates go way up through the roof. So what we're seeing from baby boomers is they're selling their homes with all this equity that they have locked into their homes, and they're downsizing to smaller homes that they plan to be on for a very long time, 10, 15, 20 years, etc. But also first-time home buyers trying to get into the market. So everybody's competing for those mid or even smaller sized homes right now. So it's an affordability crisis. Last stat I'll leave you guys with: the breakdown of real estate owned by generation. I take a look at a lot of wonky, crazy data out there to make sure that I'm understanding the layers beneath the layers. $19.5 trillion in real estate is owned by the baby boomer generation, followed by Gen X, $14 trillion owned by Gen X, followed by the millennials at $10 trillion. Very interesting to see. Okay, we see some new faces piling in. Hello to the newcomers. Welcome. We're going to kick this off. Let's get into the US dollar, the future of the US dollar here. By the way, how's my sound, guys? Tom, give me a thumbs up if my sound's good. Cool. Very good. All right, let's jump in. Let's talk about some dollars. Let's start with an overview here. So today we are going to cover the US dollar, the world's dominant reserve currency. Not only that, possibly the most dominant reserve currency in world history. We're going to talk about why and is that sustainable. Today, we're going to tell you about what a global reserve currency is. We'll start with the basics, and we'll go into how the US dollar became the dominant reserve currency, what that handoff looked like. We'll talk about the responsibilities and advantages of a reserve currency status, as well as some of the drawbacks to that. And then what threatens the dollar's position as the global reserve currency today. And most importantly, why it matters to investors. We will wrap up today with what always is my favorite part, what you can do about it as investors and the best options that you have in today's market. But for those that don't know me, I saw a few people joining for the first time. I see a lot of familiar faces, a lot of familiar names. But in case we haven't met, my name is Nick D'Angelo. I'm president of Saint Investment Group. I'm blessed. I'm honored to be considered a thought leader in the real estate space and investment economics, et cetera. And I get to be on podcasts and stages, et cetera, really fun things and meet a lot of great people. But what I'm most proud of is what we have and what we're offering today with our flagship portfolio. It's the Saint Income Fund, pays up to 14.28% returns, backed by over 600 mortgages in over 29 states and growing. And my favorite part, we haven't missed a distribution in over a decade. That's a lot of hard work by the Saint team. So a lot of glory goes to them. But it's good to meet you guys. This is an intro slide. And this is a brag slide. Again, lots of hard work by the Saint team. For our syndications that we've done in the past, we've averaged over 35% on our IRR, over 14 million distributed to investors, and again, over 600 mortgages in over 10 years of consecutive distributions. So lots of happy investors. But I always encourage investors or people tuning in to check out, most importantly, what investors have to say. Don't take my word on it. I am very obviously biased. I think Saint's the best company in the world. So I highly recommend you guys check out places where you can see reviews that we've done, that we've received from amazing investors and people that have worked with us. There's some great ones on the board now. Trusted investment company, investing in fixed income has been a game changer for my portfolio. Trustworthy, knowledgeable, and grounded. The best places to check reviews. I'll just kind of give you guys the skip to the end version of this. Trustpilot's amazing, and Google. That's where we see the most reviews on Saint. But do your diligence, check us out. If you're interested in investing or learning what we're about, a good place to start is reviews, and then you can always circle up with the team, etc. And before we get too far, I want to take a minute and I want to introduce you guys to a very important team member of the Saint team, our own Tom Furlong. So Tom, can you hop in here and tell the audience what you do with Saint and how you can help them out?
Absolutely. Yeah. Thanks, Nick. So as Nick mentioned, my name is Tom Furlong. I am the Director of Investor Success here at Saint. We're so excited to be working with each and every one of you. I work with just about every investor in our income fund. So I'm working behind the scenes. We'll have the Q&A during this call. And as always, I empower you guys to turn on your camera, ask Nick any questions that you may have, or speak on what we might be doing here that excites you. But if you have any specific questions about your situation or are looking to learn more about investing with Saint in our income fund, I'm more than happy to set up a time with you, and we can actually go on a one-on-one call, allot as much time as you need. If you've decided actually at any point during this webinar that you'd like to make an investment with us, we're honored to start the partnership with you. And I'm going to be dropping my contact information in the chat right now. So feel free to use me as a resource. We are thrilled to start the partnership with you. If you're a current investor, we are thrilled to continue growing our partnership with you. So I'll be available during this call here. You can call me directly. If not, you can schedule a time with me.
Tom, I appreciate that. Guys, Tom is an amazing resource for you. Highly recommended that you guys get connected with him. His link's in the chat. You can always jump on. He has worked with hundreds of millions in investment. He's very knowledgeable. So he can walk you through what we're doing and if it would be a good fit for you as well. So get with Tom, guys. His info's in the chat, and he's happy to help y'all. Okay, so let's jump in here. This is a brief outline of how we will proceed from here. First, we're going to jump into a quick disclaimer, normal stuff. then we're going to knock out this topic. We're going to dive deep on the future of the US dollar. We'll wrap up with a little bit of housekeeping at the end, check in with you guys, and then we shift into our live Q&A. This is consistently one of the most amazing things that comes out of these webinars. It allows us to interact live. I'm here now, right? And so any questions that you guys have about the economy today, about Saint, about investment strategy or anything, we love diving in. I love diving in. I geek out on this stuff day in and day out. So we will wrap up with live Q&A at the end. All right, quick word from our legal team. Let's make our attorneys happy here. I encourage you to read the slide, but here's the big takeaways. This is not investment advice. That's number one. Number two, this is for educational purposes only. And number three, all investments carry risk and past performance does not ensure future results. And then last thing before we shift gears, it's our book giveaway. We are literally reading this on the Saint team. This is what I am reading and what I've read and just wrapped up now. This book is called Our Dollar, Your Problem by Kenneth Rogoff. And this guy was on the IMF board. He has consulted from everybody from Angela Merkel to multiple presidents. This is a super deep dive into not just the dollar, but the other currencies that are circulate throughout the world, the history of many countries, where we got to our system today. It is extremely enlightening, and I encourage you guys to check it out. So we included a QR code, but more importantly than that, I want to give you guys this book away. I literally want to send you this book for free. So how do you get the book for free? The best way to get this book for free is that we give these books away to our top engagers on every webinar. There's three main ways that you can engage and get a free book today. One is questions and comments in the chat. We want to hear from you guys. Our investment community is extremely high-level minds, great questions, no questions too big or too small, no comments too big or too small. We want to hear from you guys. Two is responding to polls. Throughout this presentation, you'll see polls that pop up. This is not for us. This is for everybody, including us. This is for us and our community that we can see people's insights on what's going on and their perspectives on different data, on different strategies, on different things along the way. So respond to the polls. We really want to hear from you guys. And then last but not least is leaving reviews on Trustpilot. So if you found this helpful or you're a current investor and had good success with us, we'd love to get your input and hear from you on Trustpilot and get a good review from you guys so we get some good feedback. Ange, do you mind dropping the link to Trustpilot in the chat so people could leave a review if they want to be amazing engagers? And then last note here, the chat is how we interact. That's going to be our best tool to go back and forth with each other. So if you have questions or comments along the way, drop them in the chat. If it's a question I can get to on the fly, I will jump right in on that moment. If I can't, then we're going to save them to the end. We don't miss questions. We're going to answer everybody's questions either on the fly, if it's something we can plug in during the presentation, or we will answer all questions in the Q&A at the end. So I look forward to your guys' questions. It's going to be a fun time. Now, let's drill down on the US dollar. So first things first, why do we talk about the global reserve currency? Why did we want to make this the topic of today's webinar? This is because the country who controls the reserve currency status has both a massive advantage in world trade and global events, as well as a responsibility, even if that obligation is typically unspoken. So the country that issues the global reserve currency is a de facto leader, which brings a ton of privilege, but also fastens a target on the back of that nation. The US dollar, to make sure that we're being very clear from the beginning, the US dollar has been the most used global reserve currency in history and also has been so for the last century. So today we're going to look at why, what that means, what the future may hold, and most importantly, what you can do about it. So let's lay some groundwork here. What is a reserve currency? Reserve currency is typically not held in bills, not held in physical bills. Reserves consist mostly of bank deposits and U.S. Treasury bonds and bills. So foreign central banks hold roughly 3.78 trillion in US treasuries today and roughly 2.4 trillion in physical dollars of bank deposits. The reserve currency is essentially like a country's savings account, if you want to think of it that way. So other countries will choose these assets to include in their reserves based on the security, the stability, and the utility of that currency. We will go through that a bunch. This is the backbone: security, stability, and utility. Since most trade is transacted in dollars by a very wide margin today, it makes the most sense for these countries to hold actual dollars in the various forms. So countries can choose to either save dollars, knowing that the dollar is backed by the full faith and trust of the US government, and they know that historically we've been a trusted nation. And even with all our problems today, we'll drill down on why that's not likely to change. This is a good chart. This is one that's powerful and really breaks down a comparison in different categories here. So on the left side, we're going to see Forex reserves, which are the funds that are held by central banks for long-term stability. This includes unexpected needs, etc. It's kind of like a backup for them. These are primarily held as treasury bonds and bank deposits, like we said. And then we see foreign exchange transactions. The column on the right are the trillions of interactions that take place on a daily basis across the globe between nations. What we see, the reason this chart is included, is that in all categories, the US dollar dominates by a wide margin. It's not even close. So this is a good lay of the land as we start getting into the nitty-gritty here. While the dollar has dropped in value in recent months, it also retains the dominance that it still had in global transactions and as the first choice for reserve currency across the globe. Between the issuance of the euro in 1999, before the issuance of the euro in 1999, the Deutschmark held the second position of reserve currency. This was Germany's currency previously to the euro. Here's an interesting note. Over the last 6 months, the dollar's value has dropped by more than 10% compared to other major currencies in Forex markets. A drop of this magnitude is very rare, right? The dollar has not lost this much value in a 6-month period since 1991. The only other similar value losses were in 1973, not long after we got off the gold standard, by the way, and then also in the mid-80s. So what we see more or less is that a drop of this magnitude over 10% in the Forex markets is a once-in-a-decade phenomenon. However, there's always a however, right? However, the loss of value does not pose an immediate threat to the dollar's position as global reserve currency. I really like this quote from Mr. Prasad. Even as the US dollar's perch at the apex of international monetary system looks increasingly fragile, the lack of viable alternatives should keep it from tumbling off that perch. For now. Okay? So, spoiler alert, the potential of the US dollar to be pushed out of the dominant position is very low for now, right? Most global finance watchers attribute the drop in the US dollar that we saw, that 10% roughly, to the uncertainty around two things: tariffs and skyrocketing national debt. The dollar's value changes don't seem to impact reserve holdings in the short term very much, although devaluation, which we will talk about, can raise questions about the dollar's long-term stability. The share of global reserves that the US has lost in the last 25 years has really been more distributed among other currencies rather than flowing to one single alternative currency. So that fact alone significantly reduces the potential for de-dollarization. So it's fair to question whether other countries can or even would want their currency designated as a reserve. The reality is many wouldn't even want that honor because of the responsibilities it covers. But there have been some challenges to the dollar that have been made in the last 100 years. The reality, though, is that none of them have come even close to succeeding. But we'll cover them so that we know what history holds. So dollar dominance. Let's talk how dominant really is the dollar. Despite the downward trend in the dollar's share of foreign exchange reserves, it still accounts for almost 90% 8% of foreign exchange transactions. So this may sound counterintuitive, but it stems from how these transactions actually play out. The dollar is used as what's called a vehicle currency. So in the vast majority of transactions, it sits in that vehicle currency status. What that means is that two countries are trading, and each nation's currency is then exchanged first for dollars, and then they complete their trade. And then each respective currency and each respective country goes their separate ways and then trades back to whatever currency they want on the back end. Most international trade invoices, debt issuances, and loans are denominated in dollars, which adds to the exchange transaction volume of dollars on a pretty much daily basis. So it's important to note the deep integration of the dollar in global payments, in global banking, settlement systems, etc. This raises the difficulty and this raises the challenges to the dollar's position as it sits today. The dollar is literally woven into the global system of finance that we have today. So US currency in circulation. What we've seen is that the physical, actual, real currency of US dollars has actually grown exponentially over the last 50 years. Again, if you take that back to the start date of really where we saw it take off, starts at the gold standard and when we split from the gold standard. This is a breakdown. This is a good breakdown of where these dollars are held, who hold, or how many bills and what percentages of bills are overseas, etc., and how much in currency is in the United States today. The 2.3 trillion that we see on the screen here includes all dollar bill denominations. There are over 52 billion total bills in circulation today. That includes 18.8 billion $100 bills, and the rest is split pretty evenly. The reason for the huge percentage of $100 bills being held internationally is that it's the highest dollar denomination. So holding a $100 bill is equivalent to holding 100 $1 bills, right? So most of the 1.1 trillion in physical currency held overseas is by businesses and individuals holding the $100 US dollar. However, there are also some exceptions to this. Like in South America, we see a huge amount of $5 bills imported. And we see some countries like Ecuador and El Salvador that have adopted the dollar as their official currency. In many countries around the world, they also accept dollars informally. It's not official, but they do, right? So I've personally, in my own travels and experiences around the world, I've used dollars in Mexico, Italy, Belize, even Japan, right? And that's just from my limited travel experience. So just like many other countries might take dollars informally, they also might speak English informally, even though it's not the official language. There's a ton, trillions of dollars in physical currency circulating globally. But let's start getting into the data, our favorite parts here at Saint. This visualization shows the amount of currency in circulation that started to rise following the US's decision, our decision to eliminate the gold standard. What we saw is that we saw this skyrocket in response to US monetary policy near the start of the 21st century. So currency circulation includes physical bills and coins, but it does not include in this chart bank deposits, electronic payments, or US Treasury securities. This is the big takeaway, and this is the big focal point. You guys can see my pointer, right? You can see my mouse. 1971, we see this start going through the roof. That's the year that we got off of the gold standard. So we see relatively stable when we were on the gold standard, and we see it go through the roof post gold standard split. So what is money? What's the breakdown of US dollars here? Physical currency is only a part of the US dollar money supply, but it is actually a pretty small share. Bank deposits, which we call M2, especially on the economic side, you can see different charts on that. Bank deposits include spendable amounts that exist as digital credits. These are held in financial institutions, and the biggest share that we see at the bottom are government bonds. So when we talk about the trillions in US dollars, the vast majority is going to be in savings accounts and government bonds. roughly everything on screen here, we're talking 60 trillion in US dollar cash equivalents that are existing today. Here's an interesting stat that I couldn't help but include. Per day, globally, there are over $6.6 trillion in US dollar transactions. That's how powerful and integrated the US dollar is in transactions globally. For those keeping score at home, that's over 2.4 quadrillion in US transaction volume annually. That is a staggering number. The big question at this stage, we know there's a lot of dollars in circulation. Now we have a little bit of a foundation, but how did we get here? The US dollar unofficially became the world's dominant currency around 1921, which is about 100 years ago. So we're going on that 100-year mark. There's an old saying by historians that reserve currencies don't change overnight. Instead, they change slowly and then they change all at once. Before 1921, however, the British pound had held the dominant position for about 100 years also. So about the same amount of time that the dollar has been the dominant currency. Before the British pound was the French franc, also for about 100 years. The transition from the pound to the dollar was formalized. The official start date of the dollar being the world reserve currency was formalized at the Bretton Woods Conference, where the aim was to plan out a post-World War II world. So if you look back historically, over all reserve currencies, the major reserve currencies throughout human history, you'll see that the world reserve currency length averages between 100 to 200 years. So by that scale, the greenback, the US dollar, is about middle to older aged. Really, we're over the average of the last two reserve currencies. The major difference is the dominance and integration of the dollar is beyond anything we've ever seen for a reserve currency in the past. Again, we just talked about over 2.4 quadrillion in US dollar transactions annually. So let's expand a little bit on how we got here. While the dollar had surpassed the pound 20 years before World War II, technically, the change of global reserve currency was formalized at the Bretton Woods Conference a year before the end of World War II. So as World War II was winding down, right? So delegates from 44 nations met. They wanted to design a new international finance and monetary system before the end of the World War, because we knew that we would be in a different position. We wanted the new world to be designed and organized, and we wanted a currency that could support that role. The issue was, for the British pound, that Britain took huge, massive financial, demographic, and military losses in World War II. So they no longer had the might and they no longer had the faith of other nations to maintain their reserve currency status. So the US dominance pre-war, that was about 20 years pre-war, and during the war, gave the world massive faith in the US dollar. A few notable reasons for that include the US Navy, the extreme power of the US Navy, the nuclear bomb, which was fresh on everyone's mind at that period of time, and the strength of the US financial system. These are not to be understated, that they were all taken into account during this discussion. The US Navy, and just to drill down on one point, the US Navy has essentially been the driving force between keeping peace in the sea since World War II, right? Which has basically created the global shipping network that the world enjoys today. The US Navy could be credited for creating globalism because countries put their goods on ships, they ship those around the world, and that needs to be protected from things like pirates or other countries stealing those goods. That's the US Navy. So don't forget that, right? It's a very proud moment when you look at the importance of the U.S. Navy in U.S. history. As a matter of fact, if you look at our Navy today, we have roughly 7x the Navy power of all other countries combined. And then the next two below us are the UK and Japan, which are pretty close allies to us. So if you combined the top three, which are all close allies, we have over 12x the Navy power of the rest of the world combined today. Interesting takeaway. So back to the Bretton Woods Agreement. The US agreed to maintain stability in gold prices. So at the time of Bretton Woods, gold was about $35 an ounce, just to give you guys some perspective historically. Other countries agreed to peg their currencies to the dollar, and then the dollar pegged its value to gold. That was the structure. So all other currencies were now on the dollar standard, and then the dollar was on the gold standard. This arrangement is much less volatile. It was thought to be much more stable for the post-World War II world, which were, and rather than these countries making constant adjustments and changing their currencies and everybody kind of having this fluctuating system, kind of what we see today, everybody just pegged it to the US dollar. All these currency fluctuations inevitably would have led to more conflict over time, which no country in the world wanted after the devastating World War II that had just happened. But then there were some major changes. We were pegged to the gold standard after Bretton Woods, and then we shifted away from the gold standard in 1971. So it made perfect sense for the dollar to be the global reserve currency after World War II, for what we just talked about. The US was dominant economically, politically, and even militarily by a very wide margin. So as the European and Japanese economies recovered, that actually started to shrink. Those economies picked up quite a lot of steam. But as the US continued to increase the money supply to support the efforts of revitalization, reconstruction, rebuilding throughout the world, there started to be an issue. The US increased money supply and the connection to gold reserves started to break. The gold standard actually became a major hang-up for the US as the money supply increased, because the more complicated the US financial system got, the more flexibility we then needed to manage it, and being stuck to gold was seen as a major hindrance at that time. So this brings us to 1971, 50 years after the Bretton Woods Agreement, putting the dollar as the reserve currency. President Nixon shifted the US dollar off the gold standard. But, calming everybody down in the world, he assured the world leaders that the gold standard would be reinstated after the Bretton Woods system was reformed. So Bretton Woods Volume 2. But as we all know, that never happened. So there was no Bretton Woods Volume 2 that included, a re-engagement of the gold standard. There was no return to the gold. During the rebuilding of Europe after World War II, the U.S. dominated global production. We were the manufacturers, the manufacturing powerhouse, and we also had massive infrastructure. Between 1950 and 1969, the U.S. share of global output actually started to drop from 35% to 27%. But by 1971, and this is where we start getting into the juice of this, U.S. inflation was at nearly 6%, and unemployment was actually over 6%. So if you look at the Federal Reserve's mandate today, their dual mandate, they have to control inflation and they have to control employment. So they want inflation about 2%, and they want unemployment roughly 4%. So they were way over both of these at that time, and it was causing major instability. And as the global reserve currency, we needed flexibility in order to handle this. When we split from the gold standard, the lead up to this was that we had an international monetary crisis that was spiked when France, along with Germany, along with Switzerland, and finally Great Britain, all wanted to turn their dollars in for gold. They had an inkling that there were more dollars than there was gold, that the gold standard really wasn't being upheld. So instead, we had Nixon in August of 71. President Nixon suspended the convertibility of gold and established an import surcharge of 10% and imposed a 90-day domestic wage and price freeze. This was to slow things down. Too many things were happening at once, too many people coming to the U.S. for their gold, and we needed time to organize the system and come up with a game plan. So in August of 1971, Nixon suspended the convertibility of gold and basically paused and put a 90-day domestic wage and price freeze in place so we could figure out that 6% inflation and 6% unemployment. This is an important chart. So while the decision to move away from the gold standard gave the U.S. government tools to more flexibility, aka printing more money, and having more ways to fight inflation and invest in different things to drive down inflation, in the long run, it actually led to higher inflation. So more spending equals higher inflation, in addition to bigger federal debts. And at the end, what it shook out to was increased wealth inequality. So this is also what we saw during COVID. Higher inflation is actually more harmful to lower income brackets. So when the government overspends, like we see today, on things like robust government programs, for instance, then that creates more debt. That also then creates more inflation because more money was printed. And at the end, it ends up harming the lower income Americans who are actually supposed to benefit from those initial government programs that we overspent on in the beginning. So Warren Buffett has a famous quote saying that if you give central banks control of currency, the natural course of action is that they will reduce the value of currency over time to zero. So we're talking about strategic, ongoing devaluation and systemic inflation. From Buffett's perspective, that is always the course that countries take over time. This is usually driven by overspending, building up too much debt, and then printing more money to devalue that debt and pay that debt back with a weaker currency. So for those at home, does this sound familiar yet? Right? Does this sound familiar yet? So let's pick some random numbers for an example. I don't know, let's say 37 trillion in national debt, right? Let's pick a deficit number. Let's say 2 trillion in debt per year that's now being added to the debt. And a central bank, I don't know, let's call it the Fed, that prints more money to drive down the currency value so that 37 trillion in debt is easier to repay with a cheaper currency. That's what we're seeing in the graph here. That's what this graph is that it's the hike of federal debt over time and the increase in the annual deficit over time. To give you guys a painful example, this pains me to even say it out loud, but to give you a painful example, if you took $1, if you had $1 from 1913, how many dollars do you think $1 in 1913 is worth in today's dollars? Can you drop that in the chat? I want to hear from you guys. $1 in 1913, how much do you think that's worth today? Okay. Miles, good guess. A painful guess, but you're not far off. Okay, some good guesses. If you had $1 in 1913, that would take $100 today. It's the same equivalent. $1 in 1913 is worth $100 today. Okay? Painful. Now, we've talked a lot about the gold standard. How much has our currency devalued since 1971? From 1971 alone, we've seen the US dollar lose over 85% of its value. So seeing things in charts like this gives us perspective that over time, that devaluation, that currency loss by overspending is extremely important to track. And most importantly, we need to have some spending on track and have our deficit reduced. So we know there's a dollar dominance. We know the history of the dollar dominance. Let's talk about why it has remained dominant. While there have been efforts in the past by foreign countries to overtake the dollar, most have failed for a few reasons. Lack of volume, fear of inflation from that currency that's challenging, and or political philosophy. Also, there's a huge force of inertia because of the infinite complexity of our current financial system globally. So between those two things, that one of the significant reasons of the US primacy in global reserve currency status that's often overlooked is that there's a tremendous advantage in one ratio, cash to GDP ratio. That kind of puts all these ideas together. So I'll take a moment here to share with you guys a quick story. I was in Italy. I was visiting some family, my dear Uncle Baldo and me and my cousins over there, and I'm sitting in a cab. And this is in the early 2000s where people were globally, many countries really weren't liking the US. They had a lot of problems with us. We had multiple wars going on, etc. And I'm sitting with this Italian cab driver, and this guy is grilling me on the US. You know, you guys are the world police. You guys are a bunch of bullies. You guys are a big problem. The US dollar is just used as a tool to control people. All kinds of different wild theories that only an Italian cab driver could come up with, all the worst case scenarios. So I sit there, I kind of hear him out. I'm a younger man at that time. And I say, okay, hey, look, Paisan, I'm willing to hear you out on this, but let me ask you one question. What would you do if Italy was attacked? Let's say that somebody tried to invade Italy tomorrow. What would you guys do? You're not known for your Italian army these days, right? Especially if you look at World War II history. So what would you do if Italy was attacked? And without hesitation, without irony in his voice, and without a hint of hypocrisy, he responded to me, well, we'd call the US and they'd come defend us, of course. I'm sitting there shocked that this guy has the guts to just say that out loud. And I'm saying, okay, wow, I can't believe I just heard that. But okay, what if Italy completely collapsed economically? What would you guys do? What if the euro collapsed, completely economically? What would you guys do? Same response. We call the US, of course. So the dominance of the US, as much as we're hated on, the reality is we're still the first call by other countries when it hits the fan. Let's look at why. Let's look at why there's still, with all the problems that we went through of the US dollar, there's still such a strong position that the dollar holds. And we just had a quiz pop up here. So, future of the dollar in Q1. Considering the recent 10% drop in the dollar's value over the past 6 months, what's your take on the future trajectory of the US dollar? Is it a temporary blip? The dollar will quickly rebound and strengthen its global position. This is a warning sign. It's not an immediate threat, but this dip will signal potential long-term erosion of dominance. Business as usual, fluctuations are normal. The dollar's foundational strength remains unchallenged, or undecided, and you just want to see everyone's results. Getting some good feedback. I love polls. I love these polls. Okay, so we have two. If you haven't voted yet, feel free to vote in here, but we have a couple winners. What do we see that this 10% drop in the dollar's value over the past 6 months, what does our audience see this meaning as? The number one is, while not an immediate threat, this dip signals potential long-term erosion of dominance. A wise vote on this. Another, business as usual. Fluctuations are normal. The dollar's foundational strength remains unchallenged. I'm somewhere right in between those two, to be completely honest. So I love this feedback. Thank you guys for sharing. Some good votes. We got a smart group today. Okay, so let's drill down on a helpful metric here that's called the cash to GDP ratio. What the cash GDP ratio contains is an indicator of a nation's economic discipline and economic structure strength. For example, a high ratio indicates a heavy reliance on cash transactions, while a lower ratio shows adoption of things like digital payments and really broad financial trust and inclusivity. Low ratios facilitate tracking of money flows, and they basically signal an organized monetary policy. Okay. While higher cash usually means making it harder to track financial activities and basically shows a looser control of cash in a country. So, long story short, lower cash to GDP means a country has more control. Higher cash to GDP means a country has less control of their currency. So what do we see on this slide? What we see is the US has by far the lowest cash to GDP ratio of any major country, including the Eurozone, taken all together, right? The closest noteworthy example that I just said is the Eurozone, right? The euro. We have they are over 5 times less controlling of their cash. They have over 5 times less control of their cash than we have in the US. And then you look at China, They have over 15 times less control of their currency than we have in the US. And that's even with the massive currency controls of the Chinese Communist Party, the CCP, places on their own currency of how much can leave the country, transactions can occur, etc. So what we see by this important metric, we see that the US is far and wide the leader of managing our currency tightly and effectively. And it's also another reason why countries trust us with the reserve currency status, because each dollar has more economic value and more economic control behind it than any other currency in the entire world today. So what does it take to be a reserve currency? A lot of things. So we're looking at a chart here. I really like this chart. It gives us a good lay of the land. We talk about sizable domestic economy, importance of economy and international trade, size of the financial markets, convertibility, use of the currency as a currency peg or anchor, and stable domestic macroeconomics conditions and policies. I'm just going to jump to the worst performer here because it's actually a very funny story. The Russian ruble, okay? Consistently for many years, I'll give you an example of the worst so that we can provide some color on the best. Vladimir Putin has been so insistent that he actually believes with a straight face that the Russian ruble should be the reserve currency of the world. Okay? If you see Russia, which has an economy less than Canada, less than most states in the US, is the worst in every category here. Okay? So you think about a sizable domestic economy. Russia has a poor economy that's also shrinking. It's not even stabilized. It's on the downswing. The importance of the economy and international trade, Russia is not central. Only a few countries really are integrated with Russia. It's mostly for the oil side, right? Size, depth, openness, etc. No. But if we bump over to the dollar, here's the strong comparison. The US dollar to the euro. Right? I think there's 27 countries that make up the Eurozone today, that part of the euro. Let's compare the two. A sizable domestic economy. Europe has a strong economy in many ways. It doesn't touch the US, and we know that Europe's actually on a downswing, so the US would take that by far and wide. Importance of the economy and international trade. I would argue that the US is at least equal here, but what I will say is that I think the US got this rating because we have been stepping away from the global stage and want to be a little less integrated as far as having to run the affairs of all these other countries. Size, depth, openness of the financial markets. The US is by far the most accessible and open financial market in the world. Convertibility of currency. 90% of 90% of global transactions are on the dollar. So I wish there was an even stronger color to indicate this one here. Use of currency as a currency peg or anchor. That is the reserve currency status. There can only be one, and that's the dollar today. And then stable domestic macroeconomic conditions and policies. I think this is fair to give the US a mid-grade here. We have major issues politically to sort through, major issues economically to sort through, particularly with our spending and our debt. So this is the biggest one we need to work on, in my opinion. But in all other categories, we are top tier, while most of these other currencies are lagging or underdeveloped. So as the dollar has lost some of its dominance, the runoff, here's the important note, the runoff has not flowed to any single currency. Instead, it's been distributed among other world leaders. This continued dilution of shares prevents any one challenger from toppling the dollar from its top position. There are theories in the economic circles that our world is going to kind of like trade blocks and kind of regional trade. In that case, the dollar still reigns supreme by a wide margin, and still, even with regional currencies maybe picking up a little steam, the reality is that they're not likely to transition off of a US dollar centric organized financial system. So what does the dollar status mean? We're going to talk about this term exorbitant privilege. So the big question, why does the US reserve currency status even matter? Why is this even a discussion? Why is this even a concern? Does this even have any benefit, or does it take more responsibility to manage than it even offers benefit to the reserve currency holder? Let's talk a brief bit of history. The idea that a global reserve currency is an economic advantage, aka an exorbitant privilege, was started by former French finance minister Valéry Giscard in the early 1960s. What he was doing was expressing his concern about the advantage that the role provided specifically to the US. So this was kind of a slight at the US that he brought this up at all. Some economists actually discount the impact of this exorbitant privilege that he was, touting at that time, since the cost of debt to the US is not actually that much lower than other countries. So is it even worth it is a very real discussion that's being had in economic circles at different times. However, many experts also hold that the US is able to do something very powerful, which is export inflation. Because of the advantage that the reserve currency, the dominant world currency, holds, this allows us to have the ability to increase our dollar supply, which channels some of the impacts of inflation to other countries that hold dollars as reserves. The prime example here is going to be Japan. That's a whole discussion, probably for an entire webinar, so we won't over drill down. But the ability for a reserve currency, the number one benefit is to be able to export inflation while printing huge amounts of money. So that's one. The second major benefit of being a reserve currency and having a reserve currency status is the ability to impose sanctions on other nations. So this is one reason that some countries would like to see the dollar ousted as the reserve currency. If you were to think of the top two, Russia and China would probably come to mind. They probably don't love the fact that sanctions are looming at any time if they do wacky stuff like invade Ukraine, right? So, long story short, two things: exporting inflation. We can send that overseas to other countries that, that invest in US dollars or US treasuries. And the second is the power of the reserve currency to impart sanctions on other countries. So challenges and alternatives. So let's say the world did want to oust us. Let's say everyone got together and wanted to choose a different reserve currency. What would that look like? How would that happen? And who would be the top contenders on that? All right, so let's start the discussion about replacement currencies with our biggest allies. Okay, let's talk about the euro from the European Union and the yen of Japan. Let's start with the euro. I love my euro friends and family over there. While some EU leaders have aspirations to expand the euro in reserve accounts, the problem is that the euro lacks key elements of economic strength and integration when you look at it globally. Since the EU lacks a unified fiscal policy, aka there's a bunch of different countries that have different opinions on how things should go, and then they also have different fiscal goals, budgets, and debts. Bonds issued by members of the EU vary widely in safety. I would never want to put a German bond on the same par as a Greek bond, right? I would never, ever, ever want to expect those two to have the same risk profile. So because these bond profiles of all these different 27 EU countries are completely different risk profiles, etc., it does not provide a realistic alternative to US Treasury bonds. And similarly, several EU countries, namely Germany, Italy, and France, suffer from persistent stagflation. What they're seeing are things like high debt burdens, inflation concerns, and aging populations. That said, the euro is not a small currency by any measure. The euro comprises of over 20% of global reserves today, but the 27 EU countries do not share all the unified things like bonds, fiscal policy, and capital markets. So even though the EU is held widely across the globe, it is not moving into a dominant role for those reasons. Even optimistic projections about the growth of the euro is roughly about 25% of global reserves in the next 10 years. Okay. So largely The euro can be counted out. It's overly complicated. The bond structure of the euro is not something that can take the place of the US Treasury bonds that we have today. So really largely we can count the euro out. Let's talk Japan. Beautiful country, an amazing visit that I had there for quite a bit of time, but let's drill down on what that might look like. The Japanese yen rose quickly in value due to its economic boom and trade surpluses in the 80s. However, and here's the important point, the Japanese were reluctant to let go of their strict capital controls on the yen and move into a reserve currency position. This is a very common issue with Asian currencies. You look at China, Korea, Japan, they want strict capital controls on their currencies. So the reality is Japan didn't even want the responsibility that comes with being a dominant currency. Their leaders were cautious about the results of yen internationalization and didn't like the lack of control. So they didn't even want this. In the end, the Japanese experienced what was a bubble collapse, more or less, when they raised rates in 1989. Asset prices declined, especially stocks. This combined with reduced lending, this caused a liquidity crash. So as a world, we're pretty happy. If we're all being honest, we're pretty happy we didn't move to a yen standard in the 80s when Japan looked unstoppable. And hindsight, that was a very good decision. All right. Now let's look at the top 2 replacement options from countries that are largely not our allies. I could talk about this forever, but we're going to go over the highlights. These countries largely don't have our best interests at heart and may even want the worst from us. So let's start with China. Simply put, China is not seeking global reserve currency status for the renminbi, their currency, mainly due to the country's determination and need to maintain strict capital controls. Again, that's an Asian country consistent trend that they want those capital controls. So just to be clear, Nick, are you telling me that the Chinese Communist Party wants to control the freedom of their citizens? Yes, that's exactly what I'm saying. I know this may sound like a shock that a communist government wants to control their citizens and their currency, but that is the case in this case. Simply put, the Chinese renminbi is the single most manipulated currency in the history of the world. Every single month, month after month after month, the Chinese print between 2 to 5x what the US printed at the absolute height of our printing programs during COVID. Every single month to this day. Every problem we're talking about with the US dollar is way worse with the Chinese renminbi by probably 10x, realistically. And every time the Chinese relax their currency controls, they see outflows by $500 billion to $1 trillion in just a few months. So what do? They shut that window very tight and they absorb that currency loss, and they're very bummed that all that currency went other places, okay? So they're not a real viable option. But that said, China has been a leading force in the development of BRICS, BRICS is essentially a cooperative effort to build an alternative payment system. That's kind of what they came up today. That's not where they started with. That's kind of where they're at today. China has established essentially a BRICS bank that allows bilateral swap lines, is what it's called, with almost every other BRICS member and with 40 central banks around the world. That sounds pretty scary at face value, that they're trying to contest the US dollar supremacy. They're trying to set up a new bank. They have trade lines between the countries, and they also have these with 40 central banks around the globe. The BRICS effort is largely blocked, however, by the members avoiding disagreement between each other, trying to avoid financial turmoil with other BRICS members, and also, very importantly, the BRICS members really want to avoid antagonizing the US. This is clear. So if you look at Trump on this, he's been very, very outspoken. Trump recently declared that BRICS is dead, actual quote, and then threatened 100% tariffs on any country attempting to replace the dollar as a global reserve currency. Okay? He also went on to say he would impose 100% tariffs on any country playing games with the dollar. So in true Trumpian fashion, he was very clear And then he was also very vague, so that he was clear to say, hey, I'm pointing the finger at a specific group, and then also vague enough to say anyone else who has any cute ideas, we're going after you too, right? But here's some important points. While China's economy has grown rapidly since the 1980s, its share of global trade invoicing remains insanely behind the dollar. In 2024, the share of renminbi in global foreign exchange reserves actually dropped to 2.2%. The peak of renminbi foreign exchange reserves was 2022 at 2.8%. So it's really not a global currency. Nobody's really using this for their foreign exchange reserves. And we're seeing that this is dropping over time. So people are having less faith in the Chinese economy over time. China is trying to internationalize the renminbi and increase its influence, but really the only reason they're doing this is to avoid US sanctions and to hedge their bets if the US were to come after them. So China is very far off the map, but they are the backbone of BRICS, which has some big names in it. Brazil, Russia, India, China, and South Africa are the founding members of BRICS. That also now includes new members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, Pakistan, et cetera, et cetera. Many more are coming into the fold. Again, this sounds scary. This whole BRICS thing sounds kind of scary. Our President Trump also had opinions on this. What did Trump say? Anyone who joins BRICS will get an additional 10% tariff on anything imported to the US. That's in addition to the 100% tariff for any country wanting to dethrone the dollar, as we said before. So this shows how much concern there is for BRICS as a contender for the reserve currency space in the US alone. But let me be the first to tell you, BRICS does not have a snowball's chance in hell for the reserve currency status, or really any major competition to the US with any of our trade alliances. Here's a quick history. The term BRICS was actually invented by none other than Wall Street, and the source was a term used for mid to larger size emerging bond markets that could kind of be lumped together for bond trading. That's where the term BRICS came from. So this is not a treaty. This is not a mutual protection agreement for their militaries. And to be fair, this isn't even an organized trade agreement, okay? BRICS does have a bank, like we said, but it's essentially run by China. And the rest of the countries have extremely little in this bank, mostly just to keep China happy. The reality is that most of these countries don't even want each other's currencies. That's where the whole stemming of them not trading that much really comes from. So, and here's some important points that really drill this home. At the last BRICS summit, at the last most recent BRICS summit, China didn't even show up, okay? And guess what? The Russians didn't even show up. To be fair, Russia didn't show up because they had an international arrest warrant for war crimes in Ukraine. And Brazil was also a signer of that arrest warrant. So there's some complications there between bedfellows. But that should illustrate how complicated and lack of progress can be made with the international treaties and agreements and different arrangement that these countries have with other countries. Now, if you thought it was already complicated enough with BRICS, let's take it a step further. They're including new countries. Those are the countries above in parentheses, okay? They've now included countries including Pakistan, Saudi Arabia, and Iran. So if you don't follow geopolitics closely, here's the joke. India and Pakistan in the same trade agreement, in the same group. Saudi Arabia and Iran in the same group. These countries hate each other to the very core. They can't agree on anything whatsoever. The Sunni Muslim Saudis were closer to making a deal with the Jewish state of Israel than they were to making any kind of peace with the Shia Muslim Iranians. And then you factor in that China runs the BRICS Bank and didn't even show up to the last meeting, and that Russia isn't even allowed to go to meetings, okay? So the BRICS thing just doesn't go anywhere. The interests are so conflicting, the relationships are so forced that it really creates a gridlock at best. The only thing that most of these countries want, and the only thing they have in common, is to just hedge against US leadership. That is not enough for them to be partners. That is not enough for them to create trade agreements. Okay. But we're talking about the dollar. Okay. If you go back a couple of years to the BRICS summit, in the opening statements, the founding countries, including China, India, and South Africa, all said openly they have no interest in moving away from a dollar-centric trading world. They said this explicitly in the opening remarks. So where does that leave us? At best, this is a forum for countries to talk about economics. At its worst, it's nothing more than smaller countries trying to get an audience with China to make more favorable trade deals. That's kind of the reality. So net, BRICS is a talking point in US politics and in US news because it sounds really scary. But net, BRICS is absolutely not a mutual protection agreement with militaries or a treaty or a global currency replacement or anything that we need to be concerned about as a true alternative to the US dollar. End rant on that one. So we talked about bond markets. This is a good illustration of the power and the comparison of different bond markets. The size and security of bond markets is what distinguishes the US from all competitors for currency leadership. That was the issue with the EU specifically. Also, the fact that we have 27 trillion in bonds today makes it very unlikely that any country or any group could mount a serious challenge. Many reserve funds are typically held in the form of bonds, and a robust bond market is essential for that country issuing reserve, or for the country that issues reserve currency. So, what are the emerging threats to the dollar with all that said? If the US economy suffers significant disruption, or if the US loses credibility in the global economy, these events are much greater threats to the dollar than competition from other currencies. So let me sum this up. The absolute, unquestionable largest threat to the US dollar is overspending by the US. Our debt is the biggest problem that we face today. We paid over 1 trillion in debt payments alone last year. We haven't had a balanced budget since 2001, almost a quarter century. Both political parties in the US continue to overspend wildly. There's no fiscal responsibility on the horizon from either party anytime soon. As a matter of fact, it wasn't even mentioned in the last presidential debates, guys. Okay. That's how much this is not being addressed. We are on track for 2 trillion deficit this year, and we've been seeing the same the last handful of years. The Congressional Budget Office is estimating that our annual deficit will increase to 3 trillion per year by the early 2030s. So what does this cause? This will lead to rising costs of our debt, rising cost of interest payments. This will lead to a rising debt to GDP ratio in the US, a major concern. This will lead to a bigger percentage of tax revenues going to services or to going to servicing the debt alone and less towards government programs for citizens. If we don't get the US budget balanced, this will be a multi-generational problem that will lead to the end of the reserve currency status for the dollar. We are the only ones that can remove ourselves as the reserve currency. It might not be today, probably not even in 5 years, but in 10 years, in 20 years, this is a very real possibility. In order to manage our country, it needs to start with managing financial and fiscal policies in the US, and both parties need to figure this out together. So, what does this all mean for investors? Most importantly here, right? How can investors protect themselves and grow their assets? Let me get a sip of water after that. What we see is that there are consistently over time options for hedging against things like inflation, hedging for things like currency devaluation, etc. These are the big four that we are seeing as the biggest opportunities today. Commodities consistently become more expensive when the dollar devalues, right? Hard assets, real assets, something real and tangible. Also, the biggest discussion today, or one of the bigger discussions today, cryptocurrencies. We are seeing that cryptocurrencies have been considered a very good hedge. I'm not a big cryptocurrency guy. I won't sit here and pretend that I'm the guy to talk on intricate strategies within the cryptocurrency markets, but we've seen the returns of Bitcoin over the last 10 years plus, and they've been pretty compelling. There's also one that consistently does have good results if you know where to look, and that's emerging markets. This is my least favorite on this list. I'm going to be honest. This is more of a diversification play for a portfolio, in my opinion, because the reality is we just went through all the different problems that all the other countries have that seem to be worse than the US. So for me, for my strategy, for our investment thesis, we lean into the US because the old joke is if the US gets a cold, the rest of the world gets something terrible, right? Gets AIDS or something, right? So with that being said, when there are minor problems in the US, other countries have massive problems. So I'd rather just invest in the most stable, largest economy in the world that has the reserve currency. So emerging markets, they have a place in portfolios for certain individuals. They're just not my first choice. But I'll tell you what my first choice is, and this is probably isn't a big surprise. I like real estate. It's a hard asset. It's true, it's real, it produces value. And over time, we've consistently seen real estate be one of the best hedges against inflation. So this is the asset class breakdown of opportunities to consider as we go into a world where we have higher inflation. It's raising, just went from mid twos to 2.7, seems to be on the increase. We have tariff talks that might be inflationary, many other things down the pipeline, supply chains, some stress from different relationships with other countries. So what can you do about the US dollar concerns? We talked here about the opportunities for what asset classes, but what can you do about these? Here are some options to consider. Number one, don't hold too much cash. We're seeing cash rapidly devalued. We're seeing that it lost over 10% in Forex markets this year alone. We're seeing that since 2020, we have printed over 80% of every US dollar in the history of dollars. So cash is not treated with as much respect by the government and by the Fed as it should be. But the reality is, I wouldn't be holding cash right now myself. Number two, invest above the inflation and ideally in fixed assets with how volatile things are today. Again, with that Forex loss of over 10% or roughly 10%, if you weren't investing in at least 10% returns, you're dealing with a very real issue of you lost more than you made on those investments this year in the first 6 months of this year. Next, diversify your investment across multiple asset classes or across multiple investments. This could be in a fund that holds many different types of assets. It's a good diversification tool. They kind of do the diversifying for you, or it could be across multiple investments. Also a good option there. And then also, second to last but not least, invest in assets with real intrinsic value. Okay. Investments backed by physical assets are going to be king in the future here. That's what we're seeing. That's what the data is showing. And that's what dollar devaluation really pushes us to with all of our projections and all of our estimates. And last but not least, continue investing and keeping your money in motion. Don't be sitting on cash because it's the surest way to lose value. You are guaranteed a loss of at least 2.7% just based on inflation numbers. Choosing to invest consistently in the right things will give you the best hedge against the issues with the dollar that we've gone through. Warren Buffett, back to Uncle Warren, okay? Warren Buffett, just a reminder of this quote because it's so powerful. Warren Buffett said the tendency of all governments is to debase their currency to zero, and that the natural course of governments over time is to make their currency worth less. Okay. In his most recent statements, I think this was to the Berkshire Hathaway crowd, he expressed deep concerns about the US economy, saying that if we don't resolve the debt and balance the budget, that's going to lead to major problems over time. But here's where I agree with Warren more than ever. He's very bullish on the US overall. The currency debasement and the budget issues are his top concerns, but the US is still the best game in town, according to Uncle Warren here. So, one thing that we talk about consistently at Saint, one of our biggest concepts, we actually talk about this on pretty much every webinar, is the idea of an all-weather portfolio. The concept here, when you look at Warren Buffett or you look at any great, is to balance a portfolio that benefits from, let's say, inflation rises and inflation falling, or increase in the economy or decrease in the economy. The all-weather portfolio is among the most elusive achievements in investing. That's our goal when we're looking and we're drilling down on different investments and different strategies in the concept of bigger economic trends. Again, I believe that real estate has the biggest advantage when you're looking at an all-weather portfolio. I believe that fixed income in this market at high rates is going to be the biggest opportunity. What we see as the asset class with the number one opportunity in today's market is single family mortgages. Why? Because we're dealing with inflationary times. We have that debt cycle. We're spending too much. Then we're printing more money. And then that money is creating more debt. And we're increasing 2 to 3 trillion a year, our deficit, and then printing more money to pay that back. That's an inflationary spiral. So how do we invest using the all-weather perspective? How do we invest from rate fluctuations and through inflation trends that are going to be high and low, which is highly likely? We like mortgages for that reason, like I said, because if rates go up, mortgages are more stable. There's less refinances. Cash flow is more stabilized. You're dealing with multi-decade instruments of payment. You're dealing with 30-year mortgages, unlike anything in the world. Most of the world doesn't have that. Take Canada, for example. They have 5-year terms for their mortgages for their homes. We have 30-year fixed rate options. That's amazing. So if rates go up, there's also less turnover in the portfolio. We are just fine with that. We're fine with our purchasing. We like when rates go up. But what if rates go down? That's great too, because the single family home market is so entrenched. We talked about some interesting numbers at the beginning here. It's so entrenched. It's so impacted. It's such tight supply of what's available today that if rates go down, it will stimulate buying, which actually boosts the value of properties and increases equity, which means people can stimulate investment and it boosts returns for us at the end of the day. So if rates go down, we are also in a very happy position and feeling very good about it. Okay, we have a poll for you guys here, a quiz for you guys here. Given the increased central bank influence and current economic conditions, what is your prediction for U.S. interest rates by the end of 2025? I'm going to take a sip of water here while you guys fill this out. Interesting. This is an interesting one. Okay. Very interesting. Okay. So in first place, tied for first, we have moderate cuts for the end of the year. People are saying that they'll ease rates cautiously, balancing growth and inflation concerns. Also tied for first is central banks will hold steady, waiting for clearer economic signals. And then in second place or third, significant cuts. Central banks will prioritize economic stimulation, even if it risks some inflation. That's clearly the Trump path right now. He wants to oust Powell. He wants to drop rates dramatically. One estimate, he set up to 3%. Here's my bet. I believe rates will remain relatively steady. I think if Jerome Powell sticks around, or if the next Fed chair has similar perspectives as Jerome Powell, he'll see the rising inflation and be very concerned over that. He'll stick to rates until we see clearer signals of what happens with inflation. But I see the case study for all of these. I definitely see the argument for each one of these. I appreciate you guys. Thank you for sharing a little bit here. All right. And then here's a note. We love working with IRA investors. Like I said, our goal is an all-weather portfolio. The biggest increase that we're seeing right now of investment strategy is people using their IRAs and shifting to fixed income strategies in their IRAs. That gives you the tax benefits, that gives you the high return, that gives you the fixed income strategy, something that you can budget on. We are really seeing this, so I wanted to put this note in there. This has been a huge trend of more IRAs coming online. That's what we're seeing from our perspective with new investors. And then before we shift into Q&A here, if you want to learn more about our investment strategies, what we're doing in this market, how we're managing fixed income, and what we see as the best opportunities for a fixed income strategy, let's get you on the phone with Tom. You have a QR code on the screen here. You can take a picture of that and book a call. You can also text Wealth or call the number. And probably the best, you can either call Tom right now and jump on the phone with him now, or you can book a call with him in the chat with the link directly to Tom's calendar. So we have a lot moving. It's an interesting market, and we have more people interested in than ever. We're paying returns up to 14.28% annually. So look forward to hearing from you guys. Would love for you to connect with Tom and learn about how fixed income and investing in real estate would be a good fit for your portfolio in the midst of all these concerns with the US dollar. Couple housekeeping items to give you guys opportunity here. The Saint Investors Club. This is a brand new club that we're putting together. The purpose of this is to allow us to have more interface, allow us to have more time to sit down, talk about economic things that are up to date, things that are happening that exact second. This is a shorter meeting, but it's open to Q&A for the majority of this. So we will be doing this August 5th, will be our first Saint Investor Club. So if you want to jump on, you want to do some live Q&A, you want to have some great talks back and forth, we'll cover a very brief topic, something that's just happening in the news then. We'll talk about the impact of that, and we'll jump directly into Q&A so that we can all go back and forth together and compare notes on what's happening in the economy. So this is much more informal. This isn't as much of a, massive presentation. This is more of a discussion back and forth. It's going to be great. We'd love to see you guys August 5th at 5 p.m. Pacific. And then we have our YouTube channel. We put together a really powerful YouTube channel. We post the majority of these webinars in the YouTube channel. So if you guys want to check out past webinars, deep dives on different topics, this is a great place. You can go and see the previous topics that we've covered. You can see what our opinion is on these. You can get our investment thesis. This is a powerful, powerful, powerful opportunity for you guys to see past presentations and not miss them, and watch the replays of these. So I encourage you guys to check out our YouTube channel, and we'll see you over there as well.